Hello and welcome to this tutorial around managing risk. This is part of our wealth growth series here at Oracle Trades and essential to everything you trade, irrespective of whether it's a cryptocurrency, a future, a stock, or any other instrument. What we'll cover in this tutorial is the following. How do you actually quantify risk in trading? What is a risk to reward ratio? And most importantly, how can I use this all, and is it very complicated? We're going to create our own risk management calculator in Excel, and hopefully this helps you understand the principles of risk management better. You're of course most invited to work along this video in your own Excel file. How do you quantify risk in trading? Well, that's a question we often get asked. The easy answer is that it's really the maximum amount of money you can lose in a trade. So that's the risk. If you have $1,000 and you don't set any stop loss parameters, for example, for most instruments your maximum loss is limited to $1,000. The more sophisticated answer is the following. In the context of trading, risk is the potential that your chosen investments may fail to deliver your anticipated outcome. That could mean getting lower returns than expected, or losing your original investment, and in certain forms of trading it can even mean a loss that exceeds your deposit. We need to understand how risk relates to reward. So what is a risk to reward ratio? You may have come across this term. It sounds quite cryptic at first and extremely sophisticated and complicated. However, it's really quite simple once you understand how it works. Let's have a look at the definition from Investopedia, which we generally recommend as a resource for trading jargon anyway. The risk-reward ratio helps investors manage the risk of losing money on trades. Even if a trader has some profitable trades, he or she will lose money over time if his win rate is below 50%. The risk-reward ratio measures the difference between a trade entry point to a stop loss and a sell or take profit order. How can I use this? Is it complicated? So the question that comes up is how you can really use this in your trading every day. You've got so much to worry about with all the other tasks you need to manage during your trades that it's often just not feasible or possible to add another layer of analysis, as you would miss out on trading opportunities at some point. Well, let's take a closer look together and have a view on an example in 3 simple steps that illustrates risk management. You have $1,000 in your account. You decide that you don't want to risk more than $50 for every single trade. What's your maximum stop loss? Right, $50. So while I appreciate it's a very simple example, this is often the reason inexperienced traders blow up their accounts. In fact, it's probably one of the most important reasons. I think we've all been there. The trade turns against you and is about to hit your stop loss. You hope that the trade will turn around and further increase your stop loss, risking even more capital than you had initially planned. And the trade continues to trend against you, and at some point you have to take the painful decision to cut your losses. Some traders that are more emotional and possibly sometimes less experienced tend to do this consistently. And while there are occasions where this works, for example if we only observe a small correction of a trend, in many cases, the losses will outweigh the gains over time. So I thought it would be nice to do a little project by creating our own little risk management calculator that can tell us immediately what our maximum stop loss for each trade should be. This also has 2 side benefits. First of all, you're going to understand the logic of risk-reward ratio and risk management a lot better. And secondly, you may feel less inclined to manually override the parameters that you've set. So what are some factors we need to consider before we get started? Well, of course, the account balance, the size of the trade, or the quantity of the units traded, the personal risk percentage per trade that you feel comfortable with, and also how many trades you will simultaneously have open, and is your risk percentage per trade or combined? And as a bonus, let's add the risk to reward calculator. Alright, so let's have a look how we can create a risk-reward calculator. And we're going to use Forex pairs for the moment, but we're going to apply similar logic to futures contracts, which are following a slightly different methodology, but it's overall the same. I think it's best to start with some basics, so I thought we'd create ourselves like a helper table, just so that everyone's on the same page with regards to terminologies. And the first thing we need to look at is lot sizes and the values. So one lot equals 100,000 of your base currency for the major currency pairs. We're not going to talk about the Japanese yen here, not to complicate things. And then we can just use a formula and say, I'm going to divide that by 10 to 0.1 lot, and we get the value in your currency. Let's assume this was dollars, for example. And so we can just keep going. And so what we've got here is essentially, this is really one lot. This is called a mini lot, and this is called a micro lot. Okay, so if you trade $1,000, you can trade a 0.01 lot or one micro lot. Okay. Next thing is to understand the pip value. Everyone knows what pips are, but it's good and helpful to just put it in writing. So percentage and point is the meaning for pip, actually, if you didn't know that. So one pip is essentially a 0.0001% variance of a unit, okay? So if you have a currency pair, that is the multiplier to apply to get to 1 pip. So with that out of the way, let's get into the nitty-gritty of our calculator. So for the simplicity, we're going to assume our base currency to be US dollars, okay? Let's just put that here, and I'll make this a bit wider. Okay, so that's just for reference. And we're going to trade on the micro lot. Okay, so the lot size we're going to be working with is the micro lot, which is at 0.01. Okay. And most brokers will offer you leverage, right, to trade, because if you don't have as much capital and you want to make meaningful gains, you need to have leverage. Let's have a look at an example of, let's say, simply 10 to 1, okay? We call this 10 to 1, just for us to remember. And we said earlier our kind of generic pip value is the 0.301, okay? So what is our actual pip value including our leverage? Well, this now depends a lot on the trading pair, right? So we'll park this for a moment, but I want to make sure that we come up with our pip value including leverage. And this will be a dollar amount in our case, because we're having a dollar account here. So let's park this for the moment. We don't know what that is yet, right? So that's a question mark. Then we have our account balance, right? So that is something that is an input field from our side. And let's assume we only have $1,000, right? Which is our base capital. And the risk per trade we're willing to enter in percent is 5%, okay? So every trade we're willing to risk 5% of our capital, which really depends on your own kind of risk management decision. It could be 1%, 2%, 5%, shouldn't be more than 5 for sure. And so we're just going to say it's very simple. Take the $1,000, multiply it by the 5%. So no surprise, risk per trade is $50 US. We need to establish what the currency pair sits at. So let's say our entry price or our current market price is, and let's do Euro USD, okay? It's the most commonly traded pair anyway. So I'll just make that our currency pair. So entry price for Euro USD, and let's say that's 1.12. Didn't check, but doesn't really matter for this point. And now we need to see a few things, because now we know what the value of the currency pair is, and now we can calculate the pip value. So how does that work? We're going to take the general pip value, right? And because we are using a base currency of US dollars and the trading pair has a base currency of euros, we don't have to make any calculations to kind of recalculate or rebase the value of this, because essentially what this means is you can buy €1. For €1 you have to spend $1.12 at this point. So we have the cost essentially here of €1 in US dollars already. So that is one thing. So we're going to take our there's a formula, and we're going to take our pip value, right? That is our 0.01. And then we're going to multiply it by the lot size and ultimately by the leverage, right? So the lot size we've chosen is the 0.01. So I'm going to take this, multiply it by the lot size and also by the leverage. So how does that look? It looks a bit strange, right? The lot size isn't really a currency. So we have to convert this lot size into what that actually means. And we know that that is 1,000, right? So the pip value is actually not times the lot size, but times this. So let's have a look at this. Essentially what this says is that with a lot size of 0.01, that means we're trading $1,000, the full amount of capital, if you like, that we have, right? We're multiplying that by 10, so we're actually pretending to have $10,000 when in reality we only have 1,000, and that means that every pip is worth $1, because if we didn't have the 10,000, every pip value would be 10 cents, or a tenth of the amount that we are getting because of the leverage. I hope this is not too confusing, but the point is really that we need to take our pip value, right, multiply it by the number of units of the lot size we have, and then apply the leverage that we've established. So let's take this a step further. We said we've got $1,000 balance, and we established the risk per trade and the risk per trade in dollars. So how many pips can I actually risk every single trade? And this obviously is a $1 amount, right? So every pip change is worth $1. Now I want to know, what is my risk per trade in pips? Because that's ultimately the measurement we have to establish in our Forex trading. And it's not that complicated, right? It's taking the risk amount of dollars you have divided by the pip value you can risk. So you can risk 50 pips on each trade, okay? Now let's have a look. Our entry price is 1.12, and I'm just going to make this a little bit more decimal so it reflects the Forex trading displays better. And because we're trading obviously with technically 5 decimals, but let's leave it for 4 right now for simplicity reason, we need to establish what is our maximum stop loss. And our maximum stop loss is this amount, that 1.12, that is our entry price, right, minus the 50 pips. So the 50 pips correspond to $50. That's our maximum risk. The 50 pips we have to get into currency format, right? So we're going to open a bracket and say 50 times the pip value. So that would mean that at a risk of 50 pips per trade, our maximum stop loss is 111.50 on the Euro USD currency pair. And I guess you would have gotten to that number without the formula, but I thought it would be good to explain to you how to actually calculate it. Next is our profit. And our take profit, let's say, is based on our risk to reward ratio. So this is the final thing we need to establish. What is our risk to reward ratio? Technically, we're actually talking about the reward to risk ratio. So let me just change that around, because this number is going to be greater than 0. Reward to risk. So what it's really saying is that if I'm willing to risk $50, I want to take a profit of a certain amount. That could be $50, right? So it's a 1-to-1. I'm willing to lose 50, and I'm going to maximum, at best, I'm going to gain $50. But usually that isn't enough, because especially when you're not as experienced, or you may have bad days on occasion, you will not win 50% of the time. So it's good to have a risk or a reward to risk ratio, which is actually higher than 1. Let's just say 2-to-1, okay? So that means if I'm willing to risk 50 pips, I need to take twice that amount, or 100 pips, to take profit. So how do we do that? Well, it's very simple, right? We take the entry price, and then we add on the amount of pips, the 50, times the pip value, right? And we just multiply that again by the ratio we had established. So with that said, our reward would be to take profit at 1.13, which is 100 pips higher than our entry price. Okay. So that's really it. And let's just assume we want to color the input cells, our account balance and our desired risk per trade are the two basic fundamentals that you need. Then you want to obviously have your entry price that is fluctuating, and you want to update this whenever you enter a trade. And of course, your reward to risk ratio. Lastly, the lot size is really important so that you understand what it is you're trading and you don't over leverage yourself by using some of these very crazy leverage figures of 200 to 1 or 400 to 1, which may seem very tempting, but as it will show you in this little calculator, it limits your ability to close profitable trades because your stop loss and take profit will be so close that any small news event that has an impact on the currency pair will probably close you out. So let's have a look how that would look if I had a 200 to 1 ratio. And you can see that's quite a common thing you see on some of the Forex trading websites that they offer you. And with $1,000 capital and the willingness to risk only 5% per trade, which is, let's remember, already a relatively high risk, you can only risk $50. But with that amount of leverage, you're obviously trading a lot of money, right? You're actually trading $200,000. So it's if you had $200,000. And needless to say, you know, a small variation from 111.98 to 112, so that's a really, really small gap, if you think about a normal trading chart, would already result in a stop loss. And that is really the reason why most accounts blow up when you are tempted by the high leverages and you only look at the possible gain of those as opposed to looking at the risk.